Hi guys. Today we will analyze United Parcel Service stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. In the last year, UPS was an average performer in the overall market. There are mixed signals now in both the short and medium-term picture. The long-term trend is neutral, but the short-term trend is negative. Better to stay away from this stock. Support level is around $194. Strong support levels are around $180 and $158. Resistance level is around $219. The next resistance level is around $233. In the last month the stock has been trading between $192 and $233 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 10% per year, for last 5 years. We see that the average profit margin of the stock has been around 7% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 114% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for UPS company: bad, average, and good. First scenario. UPS will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 6%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $78. Second scenario. UPS will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 7%. Future free cash flow to net income rate would be average, 80%. In this case, the fair value of the stock today would be $126. Third scenario. UPS will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 8%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $189. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 14.7. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For UPS, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for UPS company: bad, average, and good. First scenario. UPS will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 12. In this case, the fair value of the stock today would be $76. Second scenario. UPS will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future P/E would be average, 15. In this case, The fair value of the stock today would be $113. Third scenario. UPS will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 18. In this case, the fair value of the stock today would be $161. As you can see, today the stock is overvalued, $209, even if we expect the company's high performance in future. Based on estimates for the next 5 years, UPS will show a small growth in revenue. The revenue will grow only by 6% on average per year. And the stock is currently overpriced. I may consider buying the stock when the stock drops below $150. Company's strengths. The world's largest package delivery company, United Parcel Service provides a wide range of transportation, distribution and logistics services. The company has 3 main business segments: U.S. domestic, international, and supply chain and freight. UPS remains well positioned to benefit from a number of positive trends, including the continued growth of e-commerce. The company provides shipping, logistics and return services for internet retailers, whose sales are growing 3 times faster than those of brick-and-mortar stores. The company has signaled confidence in its outlook with a 49% increase to the dividend, from $1.02 to $1.52 quarterly. UPS has a share buyback program and expects to repurchase $1 billion of stock in 2022. UPS has a return on assets of 18% and return on equity of 90%. This is amongst the best returns in the industry. UPS has a profit margin of 13%. This is amongst the best returns in the industry. Risks. Investors in UPS face numerous risks. These include uneven economic growth in both the U.S. and in international markets, labor negotiations, and even exposure to the struggling U.S. Postal Service. In recent years, overcapacity in the air freight market has put pressure on yields across the industry. And Amazon is taking steps to deliver more packages on its own as opposed to using UPS shipping services. UPS also has pension plan risk. UPS requires more financing than its industry peers. 80% of its industry peers have a better debt-to-equity ratio. Based on estimates for the next 5 years, UPS will show a small growth in revenue. The revenue will grow only by 6% on average per year. In the coming 5 years, the earnings per share will grow only by 5% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.